Right now, somewhere in Washington, D.C., 12 people are sitting in a room making decisions that will quietly change the price of your rent, your mortgage, your credit card interest, and your grocery bill. The Federal Open Market Committee meets 8 times a year, with 7 members from the Federal Reserve Board of Governors and 5 regional Federal Reserve Bank presidents. You didn't elect them, most people can't name a single one of them, and yet these 12 people have more influence over your financial life than any politician you've ever voted for. In 1907, a virulent financial panic exposed just how fragile America's banking system was. In October of that year, a cascade of bank runs rattled both Wall Street and Main Street. What started with a failed attempt to corner the market on stock of the United Copper Company triggered runs on banks that had lent money to the cornering scheme, leading a week later to the downfall of the Knickerbocker Trust Company, New York City's third-largest trust. Within weeks, the stock market had lost nearly half its value from the year before. Loans by New York trust companies dropped by more than a third, and factories saw production tumble 16%. The economy itself shrank, with the real gross national product falling 11%. Clearinghouses, bank associations that pooled resources, partially suspended cash payments in 73 cities. For ordinary Americans, this meant walking to your local bank to withdraw money for groceries and finding the doors locked. A handwritten sign says, "Temporarily closed." The factory where you work has cut shifts in half. Your neighbor just lost his job at the steel plant. And nobody, not the government, not Congress, not the president, has any mechanism to stop the bleeding. There was really nothing the federal government could do to step in during these periods. In such moments, the task of saving the system often fell to influential private financiers. In 1907, that meant J.P. Morgan, the financial titan who started the bank that still holds his name. At 70, he became a one-man de facto central bank, summoning bank leaders to his private library on Madison Avenue in Manhattan. What happened next sounds like something out of a movie. He ordered them to open their books, lock the doors, and refused to let anyone leave until they pledged millions to keep the system afloat. He even enlisted Treasury officials to bolster confidence. His dramatic intervention restored short-term confidence, but it also exposed a troubling truth. The U.S. financial system rested not on public authority but on the will and judgment of a few powerful men. The 1907 rescue steadied markets, but it left Americans uneasy. Why should private financiers decide which institutions lived or died? One man's personal fortune and network had become the last line of defense for the entire American economy. The severity of the 1907 panic convinced Congress that the country needed a long-term solution to modernize and stabilize the monetary system. The frequency of crises and the outsized role of J.P. Morgan renewed impetus toward a national debate on reform. In May 1908, Congress passed the Aldrich-Vreeland Act, which established the National Monetary Commission to investigate the panic and propose legislation to regulate banking. For nearly 2 years, legislators debated the proposal. On December 23, 1913, Congress passed the Federal Reserve Act. President Woodrow Wilson signed the legislation immediately, and it was enacted the same day, creating the Federal Reserve System. The message was clear. Never again would the American economy depend on whether one private citizen felt generous enough to save it. The Federal Reserve was born from that single terrifying realization that a democracy cannot survive when its financial stability rests on the whims of unelected plutocrats. What Congress created in 1913 was unlike anything that had existed before. The Federal Reserve System is both public and private, described as independent within the government rather than independent of government. Not a government agency in the traditional sense, not a private corporation either, something in between. The Federal Reserve doesn't receive funding from Congress. It doesn't need to. The president can't fire its leaders on a whim, at least not legally. This structural separation was deliberate, designed to insulate monetary policy from the electoral cycle and the pressure of whoever currently occupies the White House. The real power sits with 3 specific bodies. First, a board of governors. Each governor is appointed by the president and confirmed by the Senate to staggered 14-year terms. 14 years. That's longer than any president serves, longer than most senators. The stagger is the mechanism. If a president serves 8 years, they can appoint only 2 governors. By the time their successor takes office, the board still contains 5 members appointed by their predecessor. Members who complete a full term cannot be reappointed, though those initially appointed to fill an uncompleted term may serve a full term after. The length and the stagger work together. No single president can stack the board with their allies. Second, 12 regional Federal Reserve banks spread across the country: Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. These 12 banks and their branches function as the operating arms of the system. Each operates within its own geographic district, gathering data and intelligence on local businesses and community needs. They're the Fed's eyes and ears, feeding local economic intelligence back to Washington. And third, the most powerful body of all, the Federal Open Market Committee. It consists of all 7 members of the Board of Governors and the 12 regional Federal Reserve Bank presidents, though only 5 bank presidents vote at any given time: the president of the New York Fed and 4 others who rotate through one-year voting terms. These 12 people in that room make decisions that ripple into every corner of your financial life. The Banking Act of 1935 cemented this structure and placed monetary decisions beyond presidential control, enshrining the Fed's independence. That independence was supposed to be ironclad, a buffer between political pressure and economic reality. But that buffer is being tested right now. In August 2025, President Donald Trump announced he was removing a Federal Reserve Board governor, citing alleged misconduct. Federal law allows governors to be removed only for cause, a provision designed to protect the central bank's independence. The governor disputed the allegations and filed suit in federal court, arguing the dismissal was unlawful and politically motivated. As litigation proceeds, the legal question remains unresolved. Does the president actually have the power to remove a governor at will, or does the independence built into the Fed's structure hold? The question hanging over the Federal Reserve today is the same one that haunted America in 1907. Who actually has the power to control the country's financial system? The answer was supposed to be settled law. But as legal challenges unfold and political pressure mounts, the independence that was written into the Fed's DNA is facing its most serious test in decades. Given Trump's attempt to remove Governor Lisa Cook for cause on mortgage fraud allegations that are now being heard by the Supreme Court in January, do you think the Fed's independence will survive this legal challenge, or is this the beginning of the end for its political insulation? Comment your thoughts below. Now let's look at exactly how this power plays out in your everyday financial decisions. The real power those 12 people wield comes down to something much simpler and much more immediate. The federal funds rate is the interest rate at which depository institutions trade federal funds, balances held at Federal Reserve banks, with each other overnight. This single overnight lending rate between banks sounds technical, almost boring, but it is the foundation that every other interest rate in America is built on. When the FOMC adjusts this rate, the ripple effects flow through the entire economy within days. Your mortgage, your car loan, your credit card interest, your savings account return, all of them move in lockstep with whatever those 12 people decide in that room. Here's how the mechanism works. When the Fed raises the federal funds rate, banks have to pay more to borrow money from each other overnight. That cost gets passed along to you. Mortgages become more expensive. Car loans get pricier. Credit cards become more punishing. Businesses slow their hiring because expansion costs more. The economy cools down. When the Fed cuts rates, the opposite happens. Banks can borrow cheaply so they can lend cheaply. Mortgages drop. Car loans become affordable. Businesses invest and expand because money is cheap. Jobs multiply. The economy heats up. This is the Fed's dual mandate, the 2 goals Congress gave it in 1977: support maximum employment, keep prices stable. Specifically, the Fed aims to maintain exactly 2% inflation not zero, because zero inflation can slide into deflation, which is far more dangerous. But not too high either, because when prices rise faster than wages, ordinary people quietly get poorer every single day. You felt this tension play out in real time over the past 4 years, when inflation climbed to its highest level in 40 years, driven by pandemic supply shocks, stimulus spending, and energy prices. The Fed's response was the most aggressive series of rate hikes since the 1980s. Core inflation peaked above 5.5% in 2022. The Fed shifted as inflation slowed, cutting its target interest rate by 1.75% through 2024 and 2025. But then geopolitical events disrupted the plan. Oil prices have increased more than 60% since early 2026, entrenching the Fed in a wait-and-see mode as it balances its two mandates. The current federal funds rate sits at 3.5% to 3.75%, high enough to keep borrowing expensive, but not so high as to crush the economy entirely. That difference between today's mortgage rates and the rates available in 2021 is the difference between affording a home and being priced out entirely for millions of Americans. In 2021, you could get a 30-year mortgage for under 3%. Today, that same mortgage costs significantly more. Every quarter point the Fed moves ripples into your monthly payment, your ability to refinance, your decision to buy or rent. Even within the Fed itself, there's growing disagreement about where rates should go next. Some members want cuts to support employment, others worry about inflation resurging. The 12 people in that room are no longer speaking with one voice, and that uncertainty is rippling into markets, mortgage rates, and your daily financial decisions. This is the hidden machinery of your economic life. One number that controls whether you can afford to buy a house, start a business, or take out a loan for your kids' education. During the 2008 financial crisis, even lowering the interest rate to zero was considered insufficient to shore up economies in freefall. The Fed turned to more unusual tactics. They called it quantitative easing. Under this process, the Fed enters the market to buy securities, typically mortgage-backed securities, MBS, and treasuries, injecting both capital and liquidity into the market. In simpler terms, the Fed creates money out of thin air and uses it to buy government bonds and mortgage securities directly from banks. Your local bank holds a portfolio of government bonds worth $100 million. The Fed calls and says, "We'll buy those bonds from you for $100 million." The bank says yes. The Fed doesn't pull that money from some vault. It simply creates a digital entry on its balance sheet, crediting the bank's account with $100 million in fresh reserves. The bank now has $100 million in cash to lend out. The Fed now owns $100 million in bonds. The money supply has expanded by exactly that amount. Between December 2005 and December 2025, the Federal Reserve's balance sheet grew from about $800 billion to roughly $6.5 trillion, an increase from around 6% to 21% of GDP, $6.5 trillion. That's larger than the entire economy of Japan. It's more than the GDP of Germany and the United Kingdom combined. This expansion happened in waves. By December 2019, the balance sheet stood at roughly $4.1 trillion, up from less than $1 trillion a decade earlier. Then came the pandemic. Under Chair Powell, the Fed added nearly $5 trillion more during and after the COVID-19 pandemic. The balance sheet peaked at nearly $9 trillion, then began shrinking again as the Fed tried to unwind some of what it had done. But the 2022 to 2024 period revealed something different. Inflation hit 40-year highs. The Fed's response was aggressive, 11 rate hikes in 18 months, pushing rates from 0 to 5%. The housing market froze. Mortgage rates that had been around 3% climbed above 7%. Refinancing stopped. New home sales collapsed. Construction slowed. The Fed was deliberately making borrowing painful to cool demand and bring inflation down. By late 2024, inflation was finally falling. The Fed began cutting rates in 2025, but the balance sheet remained bloated, still more than double what it was before the pandemic, even after 2.5 years of active shrinking. The 12 people in that room aren't just setting interest rates anymore. They're actively deciding how much money exists in the American economy. They're determining which sectors get easier access to credit by choosing which types of bonds to buy. They're influencing who can afford to borrow and at what price, not just through interest rates, but by directly injecting cash into specific corners of the financial system. Every time the Fed expands its balance sheet, it's making a choice about winners and losers. Banks that hold the bonds the Fed wants to buy get an immediate cash infusion. Borrowers in sectors where the Fed is active, like housing, where it buys mortgage-backed securities, get access to cheaper credit. Everyone else pays the price through a currency. That's worth slightly less than it was the day before. This is the hidden machinery that most Americans never see. Not just the interest rate decisions that make headlines, but the trillions of dollars moving through the system every time those 12 people decide the economy needs more liquidity. Your savings account, your mortgage payment, the price of groceries, all of it shifting based on how much money the Fed chooses to create and where it chooses to inject that money into the economy. During the 2008 financial crisis, even lowering the interest rate to zero was considered insufficient to shore up economies in free fall, and the Fed turned to more unusual tactics. Under this process, the Fed enters the market to buy securities, typically mortgage-backed securities, MBS, and treasuries, injecting both capital and liquidity into the market. They called it quantitative easing. The mechanism is deceptively simple. Your local bank holds a portfolio of government bonds worth $100 million. The Fed calls and says, "We'll buy those bonds from you for $100 million. The bank says yes. The Fed doesn't pull that money from some vault. It simply creates a digital entry on its balance sheet, crediting the bank's account with $100 million in fresh reserves. The bank now has $100 million in cash to lend out. The Fed now owns $100 million in bonds. The money supply has expanded by exactly that amount. As of April 2025, the Fed's assets stand at $6.7 trillion. That's larger than the entire economy of Japan. It's more than the GDP of Germany and the United Kingdom combined. As part of the post-pandemic normalization of monetary policy, the Fed reduced the size of its balance sheet from $8.9 trillion in 2022 to $6.5 trillion in 2025. But even after 2.5 years of active shrinking, the balance sheet remains more than double what it was before the pandemic. Quantitative tightening ended in December 2025, with only half of the pandemic balance sheet growth reversed. Every time the Fed expands its balance sheet, it's making a choice about winners and losers. Banks that hold the bonds the Fed wants to buy get an immediate cash infusion. Borrowers in sectors where the Fed is active, like housing, where it buys mortgage-backed securities, get access to cheaper credit. Everyone else pays the price through a currency that's worth slightly less than it was the day before. The 12 people in that room aren't just setting interest rates anymore. They're actively determining which sectors get easier access to credit by choosing which types of bonds to buy. They're influencing who can afford to borrow and at what price, not just through interest rates, but by directly injecting cash into specific corners of the financial system. And that power is under assault right now. In late 2024, President Donald Trump moved to fire Federal Reserve Governor Lisa Cook, becoming the first president to attempt such a removal in the 112-year history of the central bank. Federal law allows the president to remove a member of the Fed board for cause, though no precedent exists for such an ouster. Frustrated that the Fed hasn't cut interest rates more aggressively, Trump moved to install more of his own hand-picked governors on the Fed's governing board. 2 Fed governors appointed by Trump, Michelle Bowman and Christopher Waller, already sit on the 7-member board. If Trump were to replace Cook, his appointees would make up a majority of the Fed board. The case reached the Supreme Court in January 2026, with oral arguments revealing just how much is at stake. Justice Brett Kavanaugh pointed out that Trump's position would kneecap Fed independence and incentivize successors to engage in search and destroy missions to find cause for removing any Fed appointee. The question hanging over the Federal Reserve today is the same one that haunted America in 1907. Who actually has the power to control the country's financial system? Back then, it was J.P. Morgan's personal fortune and network. Today, it's supposed to be those 12 people in that room, insulated from political pressure by 14-year terms and the legal requirement that they can only be removed for cause. But as legal challenges unfold and political pressure mounts, the independence that was written into the Fed's DNA is facing its most serious test in decades. The battle for control of the most powerful financial institution in the world and the $6.7 trillion balance sheet that comes with it is happening right now. Subscribe to Decoded for weekly system breakdowns that affect your money and world